Okay, so picking up where we left off in part one, now that we've been through kind of a foundational training of just the building blocks of this template here, let's start putting it back together. So first up, you'll note here that the moving average looks different. Now, instead of a traditional exponential moving average here as we were using in the prior examples here in part one here, we're now refining that a bit. So rather than just an EMA, we're using McGinley lines. Now, if you're not familiar with what a McGinley line is or how it differs from a moving average, this is an excellent article here. So you could just, if you just Googled it, the most reliable indicator you've never heard of, right? Or just or just McGinley dynamic, right? You could just do a Google search on that. For those of you that are curious about the differences, here's the exact formula, right? So if you really want to dig into it, that's a good resource. The idea is that you're going to avoid some of the whipsaw that you get with traditional moving averages here by adapting to the volatility. So it's a subtle yet meaningful enhancement to a traditional moving average. So thus, as much of what we're trying to do here, we're just trying to fine tune it, refine it, and get just the slightest bit of an edge wherever we can. So if I can create a template here with a refinement to a moving average here, that's why we chose the McGinley lines. Now, additionally, rather than just a single line here, we're using an envelope here. Now, this has been technique used for years. Nothing revolutionary here, but the point of it is to create a zone. So rather than just a 50-period line or whatever, whether EMA or McGinley, rather than just a line, we're creating a zone because all we're doing is just tracking the highs and the lows of that 50 in addition to the actual close, which is the center line. So there's a bit of a, let's see if I can find an example here. We see how narrow the lines are here, and then they start to expand here as the volatility increases. So you're getting some adaptation to that volatility in the width of the zone. But ultimately, the idea is the market has a strong tendency to revert to the 50 period, or in my case, I use a 55, but it's something in that neighborhood where we get too far from it, it'll start to come back to it. It's a bit like a reversion to the mean, right? We get too far, eventually we're going to come back towards it. So it becomes kind of a baseline for trend determination, right? There are areas here where you can't read a trend here, obviously, right? This being a perfect example of it here. But once the trend starts to establish, then you'll find that can be a great reference for. Now here, of course, you're getting through it, right? As we looked at this in part one here. But again, here's a nice zone here as we're tapping the 50. Now, as you'll recall in part one, we're using not just a 50, but we're also using a 20 period. Now, same thing in our completed template here. Rather than a 20 period EMA, we're using in my case, I use a 21 period, but either a 50 or a 20 or 50 or 21, either one would be acceptable, right? An experiment, right? Those aren't necessarily special numbers. I just think if you're in that range of maybe a 50 to a 55 and I'll call it a 20 to a 25, right? So some people like variations of that. I just tend to gravitate to the fib number. So rather than a 20, I use a 21. Rather than a 50, I use a 55. Right? Call me superstitious. It's just what I've done for years. So as we look here now, see if we start to add in the shorter time frame. Now you'll note here I have two different lines. So I wanted to show you this because there's a pretty significant difference between the two here, even though the period is the same. So for example, I have here a 21 period McGinley, right, as a substitute for the 20 period EMA we were using in part one. I have my, I can't remember what I did. I think it's a 55 period McGinley River, we call it, and then these are the two McGinleys. But if you look at the two, what's the difference between them? Let me come down here. So here's a 21 period McGinley, so the McGinley line, and my smoothing is a 0.382. That's the closer to the price action line. Just to show you the difference, here's the exact same period, but with a smooth of 618. So pretty substantial distance. The smaller the smoothing number here, so if you the 382, right, you can almost see it we could put the 50 right in the middle. You're going to be a little bit tighter to the price action here with the 382. So this is just personal preference. I just wanted to show you that slight difference here can create, not an insignificant difference between the two. I mean, if you prefer, right, you could run both of them. Although I think you start to clutter the chart a bit. So my suggestion would be to pick one, stick with it. Not dramatic difference, right? But enough here. So the 382, right, you'll see, will hug price a little bit more closely. So just that's a bit of personal preference here. So those two are the first part of enhancement to the graphical order flow that beyond what we've been talking about here with the devil's volume. So we have that. Now if we start to put the pieces together, so here we are, the same few days in the S&P as we did in part one. Now I've got the McGinleys on, right? The McGinley River and then the McGinley line, and I think I've got a 55 here on the river and a 21 with a 618 on the McGinley line. So here, right, so just nice examples here. We went through so much of this on part one. I won't dwell too much here, but I just wanted you to see that difference as we start to put the pieces together. All right, so now the next component that we would be adding in here, right, so now we've added the McGinleys, right, from the original graphical order flow that we released, I don't know, a couple of months ago. So we've added the McGinley River. We've added the devil's volume here, which we went through in pretty substantial detail here in part one. So now if we start to put the original pieces back in, so the next piece that I would add to this in the building blocks of putting this together would be the buy-sell momentum that is part of the graphical order flow. So if you're not familiar with it, I'd encourage you to perhaps go back and watch those videos here. I'll give you just a brief summary of this for those of you perhaps seeing this for the first time or not familiar with what we're doing here. So there's a number of components that are built into the buy-sell momentum. I'm going to focus on the dominant. You've got some variables and some enhancements that you can add to it, but this is how I use it. I think this is an excellent starting point. So let's focus. Let me find a good example. Here we go. This is a good one here. So we have a couple of things that we're tracking here. Remember, we're trying to get as close to an order flow template as we can without going to a footprint chart. Now, not that there's anything wrong with a footprint chart, but we're just trying to give you an alternative. In fact, I have this on one chart and I have a footprint chart directly above it when I'm trading throughout the course of the day. But I just want to demonstrate to you that, I mean, my situation is different, right? Because I have all the indicators, right? So assuming that, you've got a budget in mind with regards to the indicators that you're going to invest in. We're trying to give you an alternative here for those that aren't drawn to a footprint chart or find it paralysis of analysis, right? There's a lot of nuance to it. And I think what we've got here is something that gets you as close to a footprint chart to where ultimately you can say to yourself, you don't really need it. Okay, so not to digress here. Let's focus on this bar right here. Okay, so that big red outline on this candle here. So the two components that I have activated here in the buy-sell momentum are the outline of the bar. So what that's saying, well, let's see if I draw you kind of a proxy of it. So if we were looking at any candle, and we've here, let's see, do I want to? Oh, I guess we don't need it here. So we assume we've got some wicks on either side. So if this is the range of my candle, what we're doing with that outline, when the volume within that candle, when 70% of the volume is in the bottom third of that candle, in this case, right, so we would outline it as red, the assumption is that if volume is drifting towards the low end of that candle or being pushed by sellers towards the low end of that candle, it's not an unreasonable assumption to think that momentum will carry forward into the next candle. So that's all we're doing here is just identify. It would be like you were looking at a volume profile of an individual candle, which of course you can't do in a footprint chart. We can look at that, but rather than do it in a footprint chart, I'm just going to do it right here. So it's identifying for me where the bulk of the volume took place within the bar. So thus, if it's towards the low end of the bar, I want the outline of that candle in a hard bright red. Contrary to that, here where you see a bright green outline, that's just telling you the exact. Let's see if I can do it here. That's telling you the exact opposite. That 70% of the volume is in the top third of the bar. Right, and again, you could see it on a footprint chart, but do I need it? Do I need to see the footprint chart? right? It's telling me right now. I can see right here. I know that the majority of the volume, right, 70% of it, took place in the upper third. If I can draw on that, in the upper third of that bar. It's not going to let me do a perfect drawing, but you get the idea, right? So that's where the volume is. So the implication is perhaps that's likely to continue. Not always, right? You'll see it. You'll see it reverse. You'll see at times a down bar with a green outline. Like it's not an absolute such that if the volume is at the top third or the bottom third that the next candle is going to be in that direction. It's just a tendency, right? So we want to notate it as we can, because it's just a little bit more information that I can glean that I can't get from a candle if I'm not doing this kind of analysis. Otherwise, I just see open, high, low, close. Right? I have no idea what happened within that candle unless I go to a footprint chart. Okay, so that's the hard outlines that you see here, and I make that distinction between here sort of a dark red here and then the bright red outline. So my eye is drawn to it quickly. Same thing here. The first 15 seconds of this bar, if the volume in that candle, in this case, is 3 standard deviations beyond the volume of the last X bars, right? So in this case, I believe I would set it to 5 bars. If I get an increase in volume here, buy or sell volume here, I want that noted here. And there's the directional bias. So I know here that I had 3 times the sell volume that I'd had in the last 5 bars. Now here, right, where I've got 3 green arrows pointing up, I've got the exact opposite here. Within the first 15 seconds of that candle, I had 3 times, I had the volume within that candle was 3 standard deviations beyond the average of the last 5 candles. Right? So 2 is 2 standard deviations, 3 standard deviations. So I mean that's a big rip. So when I see three arrows within that bar, that I know that buyers were aggressive within that candle. I know that sellers were aggressive here. Not quite as aggressive here, as we're only at 2 standard deviations, but still aggression. So if I'm, as we looked at in part 2, and we're looking here in a section like this, where it's like, hey, they're trying to get back into the initial balance, right? So here's the attempt. Here's another attempt, even though it's a down bar. They're trying to get through. Right here, are we going to fail? So you can kind of see, right? I know we went through this in a lot. You can kind of see what they were doing here. Oh, here's the retrace. Let's get it. Come on, bulls. Let's get it. Let's get it back in. Wick rejection, right? So if you were unsure here, now note the 21 is inside the 55, right? So this would not necessarily be an ideal place to be entering the market because right here you don't have any edge, right? You don't know which way that's going. We have the context of the day. But if you're just working on a candle by candle basis here, looking at the very short term, well, here I've got big down volume, I've got up volume here, right down here to the devil's volume. I can see this battle between bulls and bears. Bears trying to push it down, bulls they're trying to get back into the initial balance, right? They can't do it. So now, as we start to fall away, we start to get this. Now, of course, you'd be looking left, right? We don't know what's coming, right? You'd be looking at this pivot down here, thinking, well, maybe this is just swing, retrace, and we're going to go back in towards VWAP. Now, again, this is assuming we don't, right? We know what comes, right? But you wouldn't know at this moment in time. Now, as we start to drift lower here, a trade here, well, there's probably more than you think, right? As this starts to accelerate here, just to that pivot, well, there's 14 ticks, right? Not a bad little mini scalp. Right, a little bit of a kickback here. You can see the effort here. I mean, you can literally see what's happening. As we hit this pivot here, any pivot like this, there's always the potential for just a liquidity grab, and then they just jack it right up on you, right? So that's why these can be dangerous places to enter the market at previous pivots. Right, just something to keep in mind. You can see the effort to do it here, right? But they're quickly rejected. Right now, note in this bar right here, we can see that 70% of the volume was in the bottom third. So as we come back to try and test that, there's sellers here. Right now we start to accelerate. So after the attempt here to rally off of the pivot, right? It's quickly we go towards the 2 McGinleys, quickly rejected, and then I see boo, aggressive sellers. Now what that follows by big increase in volume. Now I've got more aggressive sellers. Now I get down to the absolute pivot low here where I get this churn bar, and you can see the attempt So the churn bars, right, as we talked yesterday, high volume, narrow spread. So you can see there's a push here. You can see it, right? They're trying to push it down, and bulls are saying, right? They come back. Now, last little fight by bears, right? Nope, we're not going to let you do it. Which eventually, so again, I know it's so easy in hindsight, right? You can see the battle here. Right, there's the churn bar just to alert your eye to it. Hey, okay, looks like maybe we're running out of steam. Here's the effort to try and get back. Not hard to see it. Even though the volume is not particularly high here, you can see that the buyers are aggressive. They're trying, and that leads to this big high volume bar. Now, in hindsight, right, we can see, if you're right here, you're thinking, whoa, something's going on here. Wait, what was there news? Something happened? What happened? That's what you're wondering right here. Now note, in this high volume candle here, I don't have any arrows. Right, so it would seem that there's a lack of aggression now, even though we have high volume here. It doesn't sustain. Now right there. So note, again, you see the outline of the body of the candle telling me, well, the majority of that volume is bearish. I get the same thing here. Now, right. It starts to get ugly. So likely, so I'm completely aware of how easy this is in hindsight. Right? If we bring this over here, likely this is just a liquidity grab, right? It was just a big push up, and it's a false break, right? This is a liquidity grab, or what they're doing here is shaking out weak longs, or pardon me, weak shorts. Right now, what comes? Would they have known that that's coming? I think the Russian news comes right about 1:30. So would they have known? Is this a we don't have to assume the worst. But what's telling here is that if this was going to be a sustained push, right? Oh, hey, bulls are getting serious here. Well, now we come back, right? Note the 50 is still above the 21 in this case, and we looked at this yesterday. If this was going to be a legit rally, right? Swing, retrace, new high. Right, this is about the spot where, as we come back here to where the aggressors were, this is about the spot you would anticipate it. Not even, right? Doesn't even. Well, it would just come down here, and now we're tapping that low again. Oh, we're gonna try again. Note here, I got a little squirt here. I got 2 arrows here. I've got the bulk of the volume in the top third of that bar, but they can't get any progress here. So now it starts to look like, oh, this is starting to look weak. Now note here, rejection. Now outside of the candle is bright red. Now here's your aggression. Right now here the news comes out. Right now all of a sudden now we're in free fall. Right, just down. The speed of the selling, the candle outline. Here it paused for a second. Could have been some profit taking. Now it's just down, right, off of news, right? And eventually, now it's note what happens when we start to. It's like we've come down and a ball starts to bounce, right? All of a sudden, now I don't have until here do I see any real thrust from buyers, but note the outside of the candles, right? So I've got some buyers here trying to recover or profit being taken. Via I can see that bulls are trying to respond here. Now, note, again, I know we looked at this yesterday. We do this in a nice 3. Then we go right to the 21 McGinley. Right now down again, but you can see it. You can see here the thrust. They're starting to lose some of the thrust. So they get the kickback, and where do they go? As we talked about, it's a bit like a reversion to the mean. We come back to the 50, right? And it's a zone, to the zone of the 50. A couple of pushes here, they're trying to do it. Note the outside of the candle, right? Bulk of the volume is down here, right? So these wick rejections, you start to all we're doing here is giving you a little more context, right? I understand a little bit more about what's going on within the candle. Same thing here. Look at the red outlines. Red outline. I got no arrow. I don't have any arrows showing up here, but I can see where the bulk of the selling is. Now it starts to. Right, why? All of a sudden, green's starting to come in. Right? Why? Right? We're coming back to the prior pivot low. Right? Maybe some support here. Now here again, outline. Back to the reversion to the mean, if you will. right? Red outlines. Wicks, big wick rejections. Now here's the, you can see it. I know I'm probably going too long on this, but you can see where the bulk of that volume is. Down we go, down we go. Right, at the low, what happens, right? So I get this little reversal. So we're coming in hard. Sellers are aggressive. Then all of a sudden, oh, green outlines, 2 standard deviations. We start to push back up. Where do we go? Back to the 50. Back to the median. A little poke through, high candle, red outline, red outline, red outline. Oh, they're trying here. Can't get through. Back into the 50. Now here, right, as you know from the graphical order flow package, this means we had a selling imbalance here, right? So sellers outweighed buyers here, overwhelmed buyers 3-to-1 is a minimum here. You can set that to whatever you like, but I keep it at 3-to-1. So I know that there was a seller's imbalance here, again, right from a footprint order flow chart. I can tell, right? So the imbalance is always important to see, and that's a significant benefit of looking at a footprint chart. But here we're putting it on the candlestick chart for you. So I know here that I've got aggressive sellers. Note where the defense happens, right? So as we there we go. As we go down and come back, right? We're right back to where those sellers were aggressive. Down we go. Now at the low, right? Churn bar, 2 arrows outside of the candle. Up we go. All right, so I'm doing it in a kind of a candle by candle basis, but that's kind of how you have to read it. Now eventually you'll get to the point where you won't need to, your eye will see it a little bit more. When you're first looking at that, there's a little bit of a, oh, okay, is that an outline? I mean, you can set these to whatever you like. Now, I'm used to it now. It took me a minute because I didn't used to use hollow candles, but now with the additional information that I've gotten here, I've gotten quite used to it. Now I prefer it, actually. You'll get to a point because it's giving me more information, right? So I'm one step removed from a footprint chart, which, there's value in that. Right? We have one. I use one, but you don't need it. You don't need it, right? So if you're more graphically oriented and you can see and you like to see what's happening on the chart, you're certainly getting a broader picture here and as much detail as we can possibly give you into the candle prior to going to a footprint chart. Okay, so let's see how we are here. I think we've got those pieces covered. I think now we're ready to put it together here. Okay, so let me pause the video here for a second. We'll put the whole thing together. Okay, we finish up here with a look at the current version of the graphical order flow template, fully assembled now with the additional components that we've added to it. Now, for those of you that have already purchased the graphical order flow template, good news for you here. We are going to send to you the 3 new indicators at no charge. We only have one requirement for that, and that is that you leave us 2 reviews on our website. So, for example, if you had only just ordered the graphical order flow package from us, you might give a review on the complete package and the buy-sell momentum indicator, right? Pick a component of it and leave us a second review. We're not looking for false reviews. We're looking for honest reviews. So we'd like to know your experience with it. And hopefully this is going to make your experience with the graphical order flow all that more rewarding. We think this is refinement here that really completes the package. So just for those of you that have seen it, that are back here looking for more insight, more training, and heard that we were adding to it, that's how we hope to accommodate you. We are raising the price of it a bit, so with the addition of these new pieces, so that will be a big advantage for you having already made that investment. Again, we'll give you all the Devil's Volume, the TDI, and the McGinley lines, all at no charge to you if you'll just give us those a couple of honest reviews on our indicator site, TradeDevils-indicators.com, where you bought them. Okay, for those of you that are looking for the first time, this is the package fully assembled, and hopefully if you've been through some of the training here, you can see how the additional components are augmenting what was already there. Now, the TDI has an individual video because we make this available to Ninjatrader users outside of the graphical order flow template. So there is a dedicated video on this if that interests you, or if you're not familiar with it. That would be a good video to start with here in terms of how to apply it here. Now I'll refer to it here as we finish up here with the completed template. But that should give you detail here. Same with the Devil's Volume, that has an individual video on it. So some of this, I think, will now start to all come together as you work through those individual videos and then look at it all in one completed package. Now, for those of you looking for the first time, just a reminder that you can request a trial of this complete template for 5 trading days. No charge to that. You can try it for 5 trading days, not calendar days. We give you a full week to trade with it. Of course, we would advise that you start in sim, get used to it, get a feel for it, and with that, then perhaps you can make an informed decision as to whether it would be a good complement to what you're already doing or a replacement to what you're already doing. So let's. So here I've gone back. We looked at Wednesday, Thursday, Friday. So I went back to. I went back to Monday and Tuesday here. So this is Tuesday. So here I went back to Tuesday, February 8th, since we had looked at Thursday and Friday, pretty extensively in the last couple of videos. So here, now there's a couple of interesting things that happen on Tuesday. First, look as we open here. The 21 in my case, I've got a 55 McGinley River. So the 21 and the 55 are just going sideways, and the 21 is literally inside of the 55. Right, all through here, right? It's all inside. Now, sure, we get a little break out, a little break above, but this would not be the kind of playing field we're looking to trade within. Okay, now you could make a case here that you had something here, so we see the big spike of volume, you see the aggression via the aggressive selling inside those bars via the 3 arrows, 3 standard deviations, 2 standard deviations. We see the thrust here, but it's quickly, right, how quickly it's rejected, so it's just a perfect V recovery. But what I want you to be focused on here is that there's no particular advantage here, right? So we again, we do this in our mind's eye. We think, oh, well, of course, I would have sold it there and probably bought it here. I think the broader point here is that this is not the kind of environment we're looking to trade within, right? When we see that, it's better to stand aside because ultimately what we're looking for is some separation. Now, what's interesting about Tuesday is we get that separation. We get a distinct trend change throughout the course of the day. We get an up, down, up. So here we go sideways. The market's undecided here. Note we're staying self-contained within the initial balance, right? So at this moment in time, you're thinking, well, I'm getting up to 11:30, 12 o'clock, and we can have a range day. Well, lo and behold, right here at 10:45 here, we break out of the initial balance, right? So you can see here, oh, this is, we talk a lot about the initial test of the first test of the initial balance here, but there are days when the market is so strong where you're not going to get your reaction here, and the algo that's there is just, it's going to take a loser, just like any trader here looking. Although that said, now, if you were looking at this for a potential reversal, at no point do you really get any signs of that reversal happening here. So right out of the chute, the first thing that we see is this aggressive buyers. So we see it in the volume, we see it in the inside of the candle, and we see it on the outside of the candle. Right? So we know that 70% of the volume of that candle occurred in the top third. We know that the volume, the speed of the volume, right, per the delta, that the aggressiveness of buyers was dramatic, right? 3 standard deviations per the prior 5 bars. So we get a big burst here, and then here again, we don't get arrows here, but we know the bulk of the volume was in the upper third here. Note, right, the TDI is just going ballistic. All right, so we've got this thrust here. This movement here is the kind of thing that they need to do to break that algo and then stay outside of the IB. So this would be something to be cautious about selling into. There's just too much strength here. Typically, when we see them, you'll get some sense of a reversal, wick rejection. There'll be some signs of it potentially now pulling back in towards VWAP, but we just don't get it here. It just blows right through and then holds. What's significant here is not just getting through, is that it's not quickly rejected, right? Because you will often see that it'll be rejected and then they'll try again. Here, it's up, we're through, and we hold. So you could look at it this way, as we've talked about in terms of how to interpret the devil's volume. So we know we've got high volume here, right? 150% of the volume in the last 4 bars, right? I mean, you can see it. 1, 2, 3, 4, right? So we've got a big increase in volume here. Now we know we have liquidity here. So if indeed there are orders here that didn't all get filled, right, a little tap back into that bar here might suggest, oh, okay, well, that would make sense. I can understand why we're starting to drift higher. Now, once they make the break, look now at the separation here between the 55 and the 21. right? The two McGinleys. We start to get exactly, right? Note the difference, right? Pretty striking, right? They're on top of each other, 21 literally inside the 55. Now as we start to trend, right, we get the separation. We get price separating from the 21 and the 21 separating from the 55. Right, with signs of strength throughout. Now we do get to this here. Let me get rid of this. We do get to a period here where the volume just kind of goes quiet. I mean, we're little rotations that are up here, but we're not rip roaring here. Now first pullback, right? What do? 21 to the tick, right? Now we just sit on it. Now to get away from it, right? Note, right? So down here, right? Big burst of volume. Here's 200% the volume in the last four candles. Big thrust, right? So here, I mean, exactly what you're looking for here. So I've got a big thrust. I've got big volume here. So the market, now we're getting separation from the 21 and the 55, right? Price separating from the 21, right? Signs of strength. We get all the way up to the top here. Now let's open this up so we can see this. Okay, so what we're seeing here, we're getting multiple signs of volume deviation. All right, so then here I'm gonna have to compress this so we can see it. So again, those of you that have seen that either own graphical order flow or have seen those videos recognize what we're doing here. So we see this. That's the easiest way to do that here. So we see this big trend here, right? So this cumulative total volume here in this swing that starts. Hang on. It starts down here, right? We start down here. All of this, through the course of that swing, we get a cumulative volume total. Right, then we get a small retrace here in the red. Then as we go up here, you'll note that we get divergence here, which this line is indicating here. So I've got new price highs here, but down here, down below, right now it's a little, you have to recognize what's happening here because we get it twice. So here we have volume divergence. Now note what else is at that high. So we get a kind of a flip. You'll also notice down below, if you're looking at the TDI, look at the, I mean, it's fairly obvious to see it. As we're getting this volume divergence here between these two swings, right? So not as much buy volume here. We're getting divergence here. Now we get the drop. Now we break below the 34. We break below the white signal line. The RSI, this is a 13-period RSI, breaks the signal line. Down we go where we get separation. So note here we're getting separation from the Bollinger Bands, right, on the 13-period RSI. So I've got a big dip down here, but look below. So even though I'm pulling back, I'm not getting, you know, extreme selling pressure. If I pull this up here, you can see a little bit better. And again, we went through this in a lot of detail in the initial graphical order flow videos, but this doesn't look like I've got particularly, at no point in here, as I'm coming down, do I see any big volume spikes. So, and of course, what do we do, right? Once we break the 21, where do we go? Reversion to the mean, right back to the 55 McGinley, right? I mean, literally to the tick. Like, you can't script this stuff. Now, note down here, right? As we get down here, we start to see divergence here, right? So I get, well, let's see if I draw it correctly. I've got a lower low here that you see per the RSI getting outside of the Bollinger Bands. I come back in, and now before I tip up, I've got a lower low here, but I don't match that in the RSI. Now note here, there's no real interest amongst sellers here to bring it all the way back down towards the IB. And as we start to go, now the RSI starts to go. You know, I know it's a little harder to see as I shrink this, but now we start to see the strength reveal itself. Let's get this out of here, and we'll kind of make these bigger perhaps so you can see it here. Right, so here's the first shot, right? So I know buyers are getting aggressive here. Here's the second tell, right? So note we've come back to the 50, right into the zone. Little push. Now what are we doing? What are we going to do here? Right, we've had this divergence here telling us that perhaps this swing has just lost some steam. Now we're, again, reversion to the mean. Now a little thrust. So I know, again, remember I've got this pool of liquidity right here. Right? I know it from down below. Now what do we do? Right? Right? If indeed there were unfilled orders here, or this is just a retest here, a push, and then come back, note what we do. We hug the 21 McGinley. Right? You can see it, look right to the tick. Now we can't get over it. Oh, now we're over. Now back to test, right, into that pool of liquidity, and then on the first candle, the coming out of there. Right, what do I see right there? Right, so I've got an increase in volume. Look at the outside edge of the candle, right? So I know that 70% of the volume took place in the upper third next candle. Three arrows, right? 3 standard deviations of volume over that 5-period average, and then again and again, and then I get a churn bar. So the market kind of goes sideways here. We just kind of stall, right? High volume, the highest volume of that entire swing, right here. Yet a very narrow spread. So the market's in indecision. Once again, right, coming out of that indecision, buyers are aggressive. Note the 2 arrows, right, 2 standard deviations up, and at the very top, I get that same deviation, right? So I've got volume deviation here. So this thrust not as substantial as this, right? And the volume's not as much. We get up here, we get a classic divergence sign. Now note here, I don't get divergence here in the RSI, but I can see here that now we're getting outside. Now if I can get across here, if I'm paying attention to crosses, and we talked about this in the TDI video, I want the signal line to be as close to the RSI as I can. I don't if it gets too far from it, I don't like the signal as much, and this is, you'll pick this up as you start to watch this and trade it. So here, this gap right here, that's too big. I don't want to take that as an entry. I want to take them as close as I can, and ideally, and as we see it here, we're above the 68 line. So I'm really overextended here. So if there's a tendency for this to come back and revert to the mean, right, what do we do after that divergence? Right back to the 55. In this case, the 55, where we go sideways here. A little push, right? The 21 holds it, and then down we go. So this is a very natural target. If we see this kind of divergence here, and they're running out of steam here, the natural first target would be back to the 21, which we hit to the tick, and then a little bounce. Now we break it. Where do we go? Right, 55. Oh. Let's see here. Now, once we do get this trend change here. So having done this, now we've got this substantial rip here. We're well past the initial balance here. Now, all of a sudden, things start to roll over, right? So we've had the initial push. Now we're drifting down here. It's very typical, right? We said, so profit taking. Oh, time of day here. Oh, we're good. This is kind of 1 o'clock. We get to in the early afternoon here. Market can often be quiet here, but you'll note here now. Note the 21 and the 55 were inside of each. So much like it was this morning, no particular advantage here. I don't have the separation that I'm looking for. That just kind of alerts me to ideal trading conditions. I don't have any edge in here. Yeah, there's volume to that I can recognize here, but again, when they're on top of each other, that's a note of caution. Just again, you've got to watch it, experience it yourself. I mean, you can see it here. Right? It's not like I'm not showing you something that's right in front of your face here. So as they're on top of each other, is there much good trading here? Right? All these moves are very short-lived. Right? So it's just a lot of chop. Now, all of a sudden, we get a change of character. Right, we get this push up on high volume here, which you might have thought, oh, okay, the trend's going to continue. Right, it would have been very easy to be sitting here thinking, okay, long snoozy hour here. Now there's the rip, there's the retrace. That's what we're looking for. Right, that's what you would, if you're right here, that's what you might be thinking. Oh, we swing, retrace. I'm back to the 21, back to the 55. Now note they're on top of each other. But if I was going to get the reaction here, I get a blue bar here as an initial attempt. So it would have been very easy to think, oh, whoop, there we go. Well, slow down. Look below. Right? Does that look like I'm going to get that thrust here? Even though that was the first glimmer, okay, it's coming. It could come. Right? I can't even get over the signal line here. Right? The TDI is screaming at you. Whoa, whoa, whoa! Not so fast. Right? Remember, hey, dumbass, are you sure? Are you absolutely sure you want to be a buyer here? Now, the danger is you try and front run it. You jump. You think, oh, I know it's coming. You think you're smarter than the market. Oh, I'm just going to jump in early here because it's going to cross. Right? Very, very dangerous thing to do. You want that to confirm, right? Or it'll do just if you do it right. This is how the market has an amazing way of punishing mistakes. If you try and anticipate it, it won't cross. If you wait too long, right, and you say, oh well, now it's to the Bollinger Band. I waited too long. So there's a fine line here. But while we do get this little pop of volume here, which would have had you. Let me open this up. Looking here on edge. Oh, okay. Well, maybe this is the retrace here. We're just coming back into some of this structure here. Maybe this is the retrace where I can start to go. Well, the very next bar, I get aggressive selling. I've got 3, 2. Right, look down here. Well, I call them dumbass filters, right? Hey, dumbass, are you sure you want to buy that? You sure? Well, this is saying that's not a really smart thing to do. Now what do I get here? Now I get some volume, right? Again, I kind of say that in jest, right? Is because those are directed at me. Because as soon as the market is retracing, I'm looking to buy it. Or if I've had a swing and a retrace, my immediate instinct is I'm looking for the buy here. So I want to wait. I need confirmation before I can do it. And here I get the exact opposite. Rather than a swing retrace rally, I get a collapse. So while here was the opportunity for bulls to take it, what happens, right? Now we're below the 21 and on the other side of the McGinley, so the McGinley River. So what do I have right here? I have a potential pool of liquidity. Now I get it again here. I get an increase in volume here. I could actually just pull this down, right? So I've got a couple of bars here where I've got aggressive sellers via the two little candles in there telling me sellers are aggressive. Then I get high volume here of sellers. Now I've got a little retrace. That's probably a measured move as well, right? So if I look here, right, so right to the 618. Was there a trade there? What did you get on that if you took that? Oh, let's see. You got to take the break of that candle right to target. Well, there's 13 ticks. A little scalp, right? Of course, it keeps going, but that was just a first target. Let's get that. Oh, shit. Oh, I just did something. I didn't mean to do. There we go. No, I think I brought me off to the right edge. Well, okay, I think you're getting the handle on this. Let me bring this back down here. Oh, I think I hit. What did I hit? I think I hit home. It took me all the way to the end of the week. Well, we can finish up here. This is Friday, so we've looked at this a lot. Now, the one thing that you'll see on here that you hadn't seen before, I've got our measured move indicator on this, which if you're not. Well, I'm assuming you all would be somewhat familiar. If you're not familiar with that, we have two videos that talk about it in great detail here. This is the algorithm that moves the markets. And I have this on a very sensitive setting, so you would see how many times. So we just look at this on Friday. Every time you see this, right? That's that algo responding here. Let me get. I got a couple of things messed up there when I hit that home button. Oh, so let's see. So here we go through the initial part of the day. So here's the golden zone gets the target here. So I mean, this it just permeates, right? Here's one, here's one, here's one, right? We get a bunch of them, right? It's measured moves throughout the whole day, all the way down here. Here's one, just all day long, right? They're just nonstop measured moves, measured moves, measured moves. Yeah, I mean, you have to know where that is, right? So you'll, as I see, you'll hear me say this a lot, right? If you don't know where it is, you'll buy or sell right into it, right? So tempting to, right? So here, right? If you thought, oh, here's the push, you're right to the 55, right to the 50. TDI rolls over. So again, this if you're not familiar with the measured move, that'd be something to consider adding into this template here. Again, this is how I trade it here, the auto fibs on the side additionally, right? Those are additional enhancements, or you can just draw them yourself, right? As I do, frequently and did before we created this indicator. So there's a lot of horsepower here. Again, our whole objective here is to give you as much information as we possibly can right up to where you're going into a footprint or an order flow chart on the premise that the majority of people, they're traditionally trained to view a bar chart or a candlestick chart. Now, the gravitation to footprint charts is to get more information. So what we're trying to do here is give you the best of both. So it's a bit of a hybrid between the traditional candlestick charting and graphical view of the market as we look at swings, retrace, support and resistance, all the things, all the price action. We get to extrapolate from that price action here based on how we're used to viewing the market, but then getting additional insight into the candle without going to a footprint chart, right? I want to see the aggression. I want to see where the bulk of the volume is. I want to see where buyers and sellers are battling, right? I want to see where the volume is within the bar, right? Without having to pull up a footprint chart and decipher that. So a lot of horsepower here. We think if you test this, you'll start to see it, but I wanted you to come through the process of saying, okay, wait a minute. No, at the end of the day, there's a lot of fancy stuff on here, but really, can we simplify this? Oh, let's see. Oh, let's pull these off. When we get right here, right? I mean, just to keep it simple, when we get right into this little pocket here, having had this downtrend here, is this an area where perhaps we want to start paying attention? And then can we use the volume that we're demonstrating here as it comes back into all that pile of liquidity here to look for an entry here, and then use some of the nuances here, whether it's the TDI, whether it's the buy-sell pressure, where it's showing where buyers and sellers are aggressive, whether it's just taking advantage of the spread between the 21 and the 55, or the 20 and the 50, whatever you're using. I think it would be very difficult to not find this helpful if you're a traditional candlestick or bar chart trader. There's just more information here than you can get from a traditional candlestick. You just can't get it, right? So that's what we're trying to do here. Keeping it graphical, keeping it in the tradition of what you're used to looking at, and then looking for all those measured moves that are just, as we just looked at, they're just all over the place, so we can see them. Okay, guys, with that, I'm going to wrap up here. Just a reminder, you can try all of this out free for 5 days. Trial, well, all of our indicators, right? Anything that you're interested in, we'll give you a free 5-day trial and all of that stuff. Okay, all right, with that, I'll wrap it up here. We'd love to get your comments and feedback, and there's just a reminder once again to all of you that already purchased the graphical order flow, just a couple of reviews, honest reviews, not pimp reviews, honest reviews, and we'll send you all the new pieces of it for no charge. Okay, guys, have a good week.